let's say, an understanding of what is the French market from a VC point of view, because our approach to that, and again, we are humble people, and we acknowledge the fact that we might be wrong, but however, it's a strong conviction that we have, which is basically, starting from the market. Average exit in the US, $250 million. Average exit in France, 25 million euros. It is a sad reality, but it is a reality. Once you understand, first factor. Second factor, liquidity. Liquidity. So you're an average VC in France. Let's say you have a 150 million fund. You have, let's say, 40, 45, 50 lines. Basically, you operate the operating system of the VC operating system imported from the US, which works very well in the US, by the way, which is 40% of my lines are going to crash, and 1, 2, 3 lines are going to return my fund.
Mm-hmm.
One of the other differences of the French market as opposed to the US is liquidity. So your average VC fund in France will operate like this. It will probably have 1, 2, 3 lines with a total valuation of 1, 2, 3 billion euros, probably, but very limited liquidity. Very limited liquidity, meaning that you have almost no IPOs. I think you have 2 tech IPOs over the last 25 years in France. So almost no IPO. Limited private buyout because, well, French companies or European companies don't tend to buy startups a lot, much less than in the US. So you have very limited liquidity. So it's very nice, to have a 3 billion euro company in your books.
But you can't sell
It's
it.
another story. It's another story to sell that company for 3 billion euros. And as you know, in VC, you have a liquidity horizon, so you have to give back the money to your LPs. So what happens is that if your liquidity is limited, your fund looks very nice on paper. You have a Alan, you have a Doctolib, you have a whatever that are valued 2, 3, 4, 5 billion euros on paper, but you don't have liquidity. So what do? You sell in secondary and you take a 50% cut, and your fund is dead. So liquidity is the other big difference. So once you understand that you have an issue of liquidity with your unicorns, and once you understand that if you exclude unicorns, your average exit is 25 billion euros, well, what do you understand? You understand that if you want to be successful, you need to make money when you have an exit at 25 million euros, meaning that you have to enter at much lower valuation, meaning that you have to enter much sooner, which is much riskier, except if you spend 6 months with the founding team before you invest. So essentially, that's our approach to the industry. Mm-hmm. We enter much sooner, on paper, with a much higher level of risk, but we limit that level of risk by using a 6 months due diligence process before we invest. Mm-hmm. And it means that when we exit a company, if we exit at 25 billion euro, which is the market average, we are making money.